So this video is going to be about pension funds, baby boomers, us millennials, inflation, deflation, and the current state that we're in right now, and kind of how to move and what to expect. Because there's a lot going on that this virus, coronavirus, essentially has ignited. So it's kind of like gas was in the air, and this was like the spark that's kind of blowing it up. So why do all these things matter? Because they're all kind of intertwined. So let's step back a little bit to see, kind of how we got here. By the way, all this was like these notes I took and stuff on everything to kind of break it down. I found my niche, which is taking a complex thing and trying to break it down for you guys in even more simpler terms, just so like the average person can understand it. But I'll post the link in my bio. I'll leave it up there for the rest of the week for you guys to go check the video out yourself and see what your own opinions and thoughts of it. But essentially, what happened is in the, well, we all know after World War II, 1945, 47, 48, like towards the end of the 50s, pretty much we all came home, right, after war with Japan and everything. At that time, it was like the lost generation. That generation had just kind of given their life for, God and country in a sense, right? When they came back, obviously they gave birth and there was a baby boom, right? Because everyone went back and said, screw it, we're just going to make love and chill, right? So, we had the largest population growth in like the world's ever seen of that generation, which was like 70 million plus boomers. And, when they came of age in like the 80s and they started getting into the workforce, they didn't have any like hand-me-downs or anything, right? So everything they needed, like cars and houses and furniture, it was all them that had to produce it, make it, and consume it. There was no secondary market. So they saw this huge influx of like this consumer economy that got started, kind of like where China is now, where the average person's making like $2,000. But you're going to see over the next 10 to 20 years as that goes up and they have to start consuming because, when you're coming out of poverty, there isn't a lot of second, stuff coming down. So essentially, the boomers enjoyed that nice big burst and they made money as they were invested in stocks, bonds, real estate, all kinds of assets. Then they got another lucky break. They were in the middle of a technological boom, the dot-com boom and the technology boom. So they caught that wave. Then they caught the information age, which is now. So, us millennials, we're at the latter end. Well, I mean, the information age is still expanding, but we're like, 2010 plus is when we started hitting, 2014 plus probably when we started hitting the world. So we don't got no money to invest. All we got is a bunch of college debt and a bunch of broken promises, and that's what our generation is stuck with. Well, majority of the wealth, like 80% of the wealth, is controlled by these baby boomers, baby boomers, and now it's like for them, they were promised all these pensions when they were working. Now the pension funds have to operate at a 7.25% return on assets. And you might think that's nothing, you're making a lot more on real estate and stuff, but you got to remember this is 7% on over like billions of dollars. It's not just a billion, like hundreds of billions of dollars. That's very hard to do and very hard to move, especially when bonds as of today are down below 1%. We're going towards zero, maybe even negative bond rates. So what this causes is if they have roughly $28 trillion into the market, and they're getting ready to retire. So usually when that money is coming out and not being pumped in, that's going to cause a deflation like asset. And 48% of our debt is now to GDP in the sense of like what we consumed is what corporations bought up. So what one of the corporations did in the market has been doing since we've gotten this cheap borrowing, we haven't seen it. I'm still paying 5-6% on 30-year fixes, 4%. But corporations have gotten this great, easy money deal. And what they did is share buybacks. So let's take even one more step back. So there's three ways you can make money off of stocks, right? Your price, the company does three things. It could give you for the shareholder. It could sell to somebody else, right? Like, who sold recently, like, Jesus, I'm drawing a blank right now, but I guess take Disney. So how Star Wars sold to Disney if they were publicly traded, or how, ABC sold to Disney. So ABC was publicly traded back in the day in the 90s. It was a publicly traded company and it sold to Disney. So Disney, bought them out. That's one way you can make money for shareholders. Second way is dividends, where, hey, we make $1 million and we're going to give out 200 to shareholders. We're going to keep the rest, right? And then the third way is retained earnings. So retained earning means the company just says, hey, we're going to hold this money and we're going to invest in the business. And as the business, and hopefully they make the right investments, and then the business is going to go up, right? Because they're going to go invest in new technology, faster, better ways to do things like that. And another way is for retained earnings, they could also do, for the fourth way, I guess, is share buybacks. So if they go to the public themselves and the company buys its own shares back, then it allows, for the stock to go up because there's less ownership and less, equity. And then essentially what the company does is that it goes into their treasury, and they could either destroy those stocks or hold it, maybe to sell it at a later time, but most likely they destroy it and they hold it themselves. So that makes the share price go up. That has been the most popular thing in the last 6 to 7 years, because if you do dividends, you got to pay taxes on those dividends. If they sell out, well, then they're not in business anymore, right? And if they expand their business, I mean, there has to be proper consumption, and the numbers got to make sense. Sometimes the easiest thing to do is just buy back your shares. And you're like, we're making all this money, or we're going to borrow this money, we're going to buy back our shares, we'll create the wealth. And then as we buy back those shares, we'll have less shares to give out, or less money to give out to everyone else. And we can use that money to, in theory, that sounds great. And these were kind of the measures that have been going on the last 6, 7 years to keep this market pumped up. Because reality is, last year there was an earnings slump. There's only been like the FANG stocks that have produced and boosted this company, the stock market up. The coronavirus is what's really making things bleed now. Because what happened is, you have these things called zombie corporations. They're not like Walking Dead like zombies, but essentially a zombie is dead, right? So what they're saying is these companies are dead. Like if you have a company that, borrowed $10 million, right, to buy back its share, and essentially use this thing, they bought back all these shares, and essentially what happened is they said, okay, now we're making $1 million a year, but our interest payments are $1 million. So they're not really growing, they're not really shrinking. They're just stagnant, and they're just waiting to, I have no idea, they're dead right now, and they're trying to figure out a way to navigate through this, maybe figure out a way to refinance or cheaper debt, maybe sell off something, to do something with it. Well, then what happens, boom, when you get a coronavirus in there, things start slumping, and then credit starts tightening, and not just credit, but your cash flows. I mean, take David Buster's, for example. They levered up, to develop and buy and do things. And now, if no one's coming in, and these corporations are only living off of the money that's coming in to be able to pay stuff, they can't pay stuff, things start drying up. Now, you're going to go bankrupt, essentially what happens. Like, when I was researching those American Airlines stocks, they had only 17% of last year's revenue as, cash on hand for something like this. I mean, that's 1/5. That's like 2.5 months. After 2.5 months, they're going to burn through that cash. They're going to need something. But coming back to where we started with, so what happened is these companies started doing this, so their stock looked more enticing, and institutional investors like CalPERS and pension funds were making a lot of money off of this thing. Now, what happens when it all does blow up? Essentially what's going to happen is you're going to have asset prices falling like they do, pension funds not being able to pay out their pensions because the money is not going to be there anymore. So essentially you get to go and take two steps. And if you look at the picture I posted earlier, it was like a snake that was eating itself, right? So these are the things that was kind of like, we're financially engineering something, which we're going to have to do. And I'm going to talk about it in another book. I just finished reading. It'll be the next video posted will be this. But essentially it's like we created these instruments like, bond stocks and CDs and collect CODs, where you're just swapping, and credit default swaps, and then options and all this. It's all financial engineering to prop up something, which is fine. I mean, not all debt is bad. If you're buying something that's going to make you money, that's great. Now, if you're buying something or spending money somewhere where it just goes down and there's no positive, impact from that, it's not making a profit, it's not creating value for everybody, it's going to end very, very badly, because that capital only goes to things that, are most effective and most efficient, because they make money and then you get more money back. But I digress. So one way is to deflate. And basically, you're going to have, on both ends of the stick, you're going to have falling asset prices, falling rates, and lower growth. And, it's and negative interest rates and more quantitative easing from the government. So that's the deflation side. And now the inflation side, you'd have, uh, same thing with savings being wiped out, higher interest rates, and lower growth. Because when inflation's there to combat it, you have to raise interest to be able to stop prices from coming down. And basically what this is really going to come down to is the video is talking about. It's a political, it's going to be a political thing because, in the broad sense of something, at the end of the day, someone's got to spend money, right? So let's go back to your Econ 40, Econ 50 class, right? The macro finance class 40 or 50 for me. I don't know what it was for you, but essentially when you get into this kind of debate, you either do nothing and you kind of just let things work out. Free market plays this thing, which is probably not a good idea, as we've seen in the Great Depression and times before. Someone has to do something. Or number two option, there's no one particular order, but number two option is that the people start spending. And we could do this by using, instruments of confidence, such as lowering interest rates, lowering things, and getting people to go out and start consuming. Or option number three is the government starts spending. And this is when you see, like the New Deal. This is where you see Social Security, Medicare, and you see, like the highway infrastructure. Someone got to get to work. You got to get money going in, because right now there's no money in the market because everything's dried up, right? And the Fed put stimulus in, but the banks are scared to lend that out because they're still going to be, they're still going to owe on it, and they don't trust the fundamentals of some of these companies, right? So essentially, that's what it means by you're in the rock and hard spot. You're in a rock and a hard spot, So one thing's got to go. And they said politically because, it doesn't make sense for us as a nation, if you're a baby boomer, if you're voting, for for us to go ahead and go give like free college for all and free, Medicare for all, and take care of other like social programs, because what that does is it limits growth in the economy and it lowers those asset prices and it lowers the money's going in elsewhere. What the boomers want is to prop up the market, go ahead and give further stimulus so they could keep their assets high so they could retire. So you're going to have this clash. You're going to have this clash of two ways. And ultimately, I think it is going to be impossible, because you got to think about it. The Fed's already used all of its ammo. They've already they've dropped Fed's interest rates. They've done everything. Only thing they could do from here is go into negative interest rates and to get people to borrow and incentivize to borrow. And that would be a deflationary period. And that's what Japan's going through since the 90s, and that might not be the best route. I'm not saying I know what the best route is, but if they go through the other aspect of it where they pump money in and we give all these entitlements, it could be really setting us up for harm. But we're going to have to do something. And at the end of the day, I don't have the answer. I don't know. That's something we're going to have to decide. And I know this just seems kind of like a lot. Like, I was listening to it, and, because at the end of the day, we would, one way or the other, you're going to get a melting point where someone's going to feel like they got the short end of the stick. Either the baby boomers are going to feel like, what the hell, where are my pensions at? Because the market's tanked because we haven't planned for it. It's inefficient, and we promised them too much. And there could be riots like in France, like in Greece. Or you keep burning this generation, and we'll never get a chance. If you keep propping prices up and don't let the market take over, prices will never get cheap that you'll get our generation in to actually be able to create wealth for ourselves. So, and ultimately, overall, for the bigger picture of the economy, like, this virus needs to settle down first. Once it kind of settles down and we know, who has it, how do we stop it? Like, not stop it, but like, kind of get adjusted things, and we can start getting into a state of normal. Then we'll be able to see which way markets are going to go and which way companies are viewing their earnings and all that. Then we can make proper evaluations on what the stock needs to be. Right now, you just be speculating. You're just like, fuck, just give me this cash. I'm going to throw it all on black and let's go, because you don't know and what if the rest of the year we're quarantined? You know what I mean? So, I mean, it's probably not likely, but these are the questions that we have to wait and face. So it's just really interesting times, and I think we have a lot more challenging days ahead, and it's not going to get easier, but obviously we've gotten through 2008, we've gotten through the Great Depression, we've gotten through multiple recessions. There's nothing that we're not going to be able to get through again, but it'll be interesting to see how this one navigates, and also interesting to see when our points will be to strike to build wealth for yourself and for your family and for the future. So, like I said, I'll post a video. I highly encourage you guys to check it out, and I hope you guys learned something from this video. Like, comment, share, and see you guys next time.